Warren Ingram from Galileo Capital with us this evening. Do you own shares in your personal capacity? I mean, not unit trusts or an RA or pension fund of any kind, but a portfolio of shares. Maybe you inherited a portfolio of shares if you were lucky. Maybe you started dabbling in shares. Maybe you're trying it out. Maybe you got burned. How's it going for you? How do you manage it? Give us a call on 021 446 0567, 011 883 0702 if you own shares and if you love it. If you regret it, whatever the case might be, should you ever buy shares? Warren Ingram, why do you want to upset me like this?
I'm trying to understand why I'm upsetting you.
Because, I mean, everybody should own some shares, shouldn't they? I mean, I don't, because people then accuse me of conflicts of interest and stuff, so therefore I don't own shares directly, because it's more trouble than it's worth. But I would love to have a little share portfolio and occasionally buy some shares and occasionally sell some shares and feel like Gordon Gekko for a while.
Yeah, so I mean, my answer is yes, that people should buy shares and that they should at least dip their toe in the water once they start the investment journey to understand how markets work. And the easiest way to understand how markets work, well, not the easiest way, but the best way, I would say, is to actually understand it on the ground with companies that you've bought and watching them go up and down and starting to understand how and why, because that will give you a great understanding of what's happening in your retirement funds, potentially in your unit trust portfolios and the like. And I think sometimes, it's quite easy to just sort of judge the results rather than to do the homework to understand what moves your investments, in a direction. But the question is more just about the last, I think, probably 2 or 3 years of kind of big corporate blow-ups that we've seen in South Africa. And I know it's a funny question, but it's one I'm being asked quite a bit at the moment, is people saying, I've got this portfolio, had so many landmines that have kind of destroyed growth in the last while. Why on earth do I still buy shares? And it's a topic of conversation for a lot of people.
It most certainly is. I mean, in bull markets, everyone's a genius, because generally in bull markets, everything goes up. And that's really good, because if you can invest in half decent companies, you can make a decent enough returns. But it's when share prices collapse, as they have particularly in companies like, let's start naming them, Tongaat. Let's look at companies like Old Mutual and Steinhoff and Aspen and EOH and Resilient. Wrong name for that company. And just companies have fallen so hard from grace. Sometimes because they were just ran too hard and were too expensive, and people kept buying the shares because they thought the rules had changed on investing. And sometimes because the people inside the companies were crooks, and sometimes because they were having nasty fights with each other. Lots of reasons. And it gives you a real stake in these businesses. But when corporate South Africa stops behaving properly, you do have to question your sanity in wanting to own their shares.
And I think that's probably the real conversation right now for investors is, how much can we trust what's being told to us by corporate South Africa? How much can we trust the numbers that are being published? And the annual reports. I think Tongaat had award-winning annual reports for quite a few years. So that's to me a body blow both to the audit industry and the kind of reputation of the JSE at large. And
the so judges of annual reports, because were they looking at annual reports because they look pretty, or were they looking at the fundamentals of the business as disclosed in the annual reports?
And I mean, not being funny, but the people that judge that is a thing called the Investment Analysts Society.
Yeah.
So I mean, they have to answer some serious questions about themselves, and I think the same for fund managers, who've been buying South African shares and have participated, as much as all of us have, as individual shareholders have participated in buying these companies that have blown up. And I think it's very easy, for us to sit back now and say, but surely these were obvious, and surely, any idiot could have seen whatever the blow up was. and I think that's, it's hindsight is a wonderful thing. But I think some of these, there was some writing on the wall, and then others would have caught pretty much everybody by surprise.
Okay, so I mean, if I have a unit trust or have a retirement annuity, or I go to your friends at Core Shares and I buy little bits of shares, I have that exposure to companies. I take risk and I invest my money. And you tell me that taking risk is good because it's only by taking sensible risk that you then can really benefit. Your money can grow and you get rich over time. That's the theory anyway in investing. And that's what the great American dream is. And that's what the thousands of books written on the subject tell us that we must do. But there are just too many catastrophes for me to trust investing directly in shares, because I don't have the skills, the know-how, the mathematical knowledge, the time to do the work that requires me to make sensible decisions.
So I think this is where the balance in the argument needs to come in, is that, firstly, if you're going to buy individual shares, then I think your comments around time are important. You need to commit the time to doing the homework and understanding what you're buying, and understanding what you're buying is not listening to your mate who's told you about the last 5 shares that he's bought that have gone up and he forgot to tell you about the last 15 that he bought that went down. Yeah. But it's actually doing proper homework on those businesses, understanding what they are. You're going to have to go and take the time to go through their financials to look at what these companies are actually doing with the money that they're earning from their business, and what are they doing with dividends and cash flow, etc. And I think that, you have to go through that education exercise. If you're not prepared to do that, you don't feel confident enough, or you don't feel you've got the ability, or you don't want to teach yourself, because, as you said, there are so many books available already. There's so much information available on the internet, that actually, to say that there is a lack of knowledge or access to knowledge is probably just an excuse now. There's plenty. There are so many great books that have been written about how you can educate yourself on share investing. But if you're not prepared to do that, I'm not saying then avoid shares altogether. Then I'm saying, don't avoid the stock market. Buy an exchange traded fund. Buy a unit trust that has share exposure, because there is a really good argument to be in the stock market. And right now, as you said, there's so many blow-ups that people are feeling, over and above the general kind of pessimism. They're saying, well, I just can't trust it. And I think that, a couple of things to point out. This sort of blow-up that we see now, with a few, either delistings, which is one big sign, and we need to talk about that, and then also companies just, kind of having the share blow up. Those are often the signs of the end of a long period of downward return. So the jargon is the bear market. And what's interesting about South Africa is we haven't really had one of those where the markets dropped sharply, and we've all experienced this big loss, and we look back and we say, okay, that was a bear market. What we've had is, kind of years of inertia, nothing really happening, but perhaps the result is the same, that after inflation we've gone nowhere with our money, we've probably gone backwards, and so now we're in a situation where companies that potentially haven't been running as efficiently as they should, been using too much debt, haven't been saved by rising asset prices. For example, Tongaat, they haven't been saved by the price of their land that they own going up, and suddenly they can't just rely on that now to get more funding from banks, and banks don't really want to lend, and suddenly we realize the emperor has no clothes, and nor does his financial director, and nor does the legal person, etc. And so there are either bad behavior or just simply poor management gets exposed.
And unfortunately, all of this stuff gives investing a bad name. And people say, well, why must I put money into the stock market? Do you not know about Steinhoff? Have you not seen what's happening in the Old Mutual boardroom? Do you not see what's happened to Tongaat? They claimed that their land was worth so much, and the properties have to be revalued, and that's left a big hole in their balance sheet. And and it's a gamble. And it's incredibly tedious conversation, because you can't argue the facts, and there are lots of those facts on the table, but it doesn't make investing bad. It doesn't make owning shares directly or indirectly bad. Surely.
No, it doesn't. And in fact, those arguments that are all over the place right now, cause certain investors to smile. Because what it means is that there's probably capitulation. In other words, that people en masse, the kind of the group of investors who would normally be buying shares, have now given up on the stock market, and that's a wonderful opportunity for people who are patient, who look around and say, okay, that means it's time for me now to go and do my homework, and to actually start to buy those companies that aren't rubbish, that are doing good business in very difficult times. Because when times get slightly less difficult and potentially start to get easy, that's the time that those companies really start to perform, and that's when the patience of the investor kicks in. And that would be my main comment to people listening tonight is don't be in the part of the herd that just capitulates, that just does what investors worldwide have done, year after year, cycle after cycle, where they act in kind of almost mass stupidity in a way, and you look back at a market and you say, well, hang on, that was obvious. That was the end of the downtime. And suddenly, 2-3 years later, everything's good again. And we won't know why things are good, and we won't know exactly what the point was that caused things to turn in favor. But the fact that markets do turn in cycles is a known, and the fact that this is a difficult set of economic conditions is a known. What we don't know is what the future looks like. But to kind of predict the future based on the last few years is silly. It's not going to repeat itself. Something else will happen. Could be worse. That's
exactly.
true. It could be worse, but it could be better. And I think you always talk about this, that whatever the situation is that we're in today, this country, this stock exchange has been faced with much worse economic and political conditions in the past and delivered fantastic returns. So I think that's the point is don't be impatient and don't be part of the bad part of the herd. Be the few smart cows that really make the money.
What most people don't understand about the JSE is that 70% of it is offshore. 70% of the money that is made by companies listed on the JSE comes from outside of the country because companies are globally diversified. And that's not always been a great thing either because lots of companies have made blunders around that. But when it comes to owning shares, and we agree that you should in some form or other, very often it's worthwhile to outsource the responsibility of the day-to-day fear, emotion, excitement, adrenaline rush to either somebody who's going to manage it on your behalf or simply to the index. As we've learned over time, very few active managers who charge higher fees than average are able to outperform after costs the average of the market. The market has proven itself over many, many years to be quite a good self-regulatory mechanism of getting rid of the rubbish and bringing in the good stuff.
Yeah, 100%. I mean, I think, and that applies in South Africa and overseas. So I think that, we shouldn't give up on the market as a whole. That's a silly thing to do. But just very quickly for the parents, listening or young people, don't forget that you've got a whole universe of shares to buy. It's not just South African. I think that's the comment here. This is about individual shares anyway. And one of the ways that private investors have made really good money over long periods of time, far more so sometimes than professional managers, is by exercising their common sense. And that means, for example, buying businesses in which they believe. In other words, they buy the products of that company or they buy the services of that company. They see that the company has got a good advantage. And they say, I'm a huge consumer of this. I believe that many other people are as well. And we are going to be for time. So I'm going to buy the company shares as well.
Okay, so hold on. Let me paint a scenario. I shop in Resilience shopping centres. I have an old mutual life insurance policy and I like to, when I go to the UK, go to Gourmet Burger Kitchen. I also like to fly on SAA as my preferred airline, and I like to buy my clothes at Mr. Price. And I also love Goma Goma couches, which may get made by Steinhoff. You get my problem is that, so often we can't even trust the brands we love with our money to invest.
Yeah, but you might be on Instagram all the time, and you might be using an Apple phone, and you might be playing, well, maybe not you, Bruce, but kids are playing, EA Vision games, and looking at the future through Tesla, for example, and saying, well, hang on, these are the companies that are going to change the world, that are going to do big things, and I'm watching Netflix, I don't watch TV anymore, and so those might be the businesses that they would be buying.
No, that is very good guidance, but yeah, look, be careful. I mean, I'm getting so many questions at the moment. People are going, the binary options thing is coming back, by the way, Facebook advertising. People talking about trading. I need to learn how to trade. Can you advise me how to trade? No, I can't.
My advice is don't.
I mean, it's world's best advice. Don't. And people in crazy times start looking for easy ways out. And can we just reemphasize? There is no easy way out.
No, and I think the easiest way to make good money over periods of time is to be greedy when others are fearful. That's right now. Everybody's fearful. Maybe it's time to get greedy, and then be patient, because the real ingredient here is sometimes just a little bit of patience for a little bit of time, and watch how your money starts to grow on itself.
Warren Ingram, Galileo Capital. Thank you, Warren Ingram. Should you own shares? Yes, you should. Should you own them directly? Well, not if you don't have the capacity to do the research and understand and have the time to do the sums and and really pay attention to what's going on in the companies. I wouldn't recommend it, and I wouldn't recommend it listening to your buddies at the Bri as to which are the next hot stocks, because the only thing hot there are the coals. Just be very, very, very cautious about going into an area that you don't understand, because people talk about it because they saw something on Facebook. It doesn't make it true. As Abraham Lincoln never said, don't believe everything you read on the internet.